All right, so continuing on with our discussion of partnership formation and operation, I want to talk about the term partnership dissolution. Dissolution is a legal term of art, and thus essentially means that any change in the partnership results in the dissolution of the old partnership and creation of a new partnership with whatever change that has been made. And so, this could happen every once in a while. This could happen continuously in like a big partnership involving lawyers or accountants. So just make sure you understand that dissolution does not necessarily mean that the partnership is being dissolved permanently. It just means there's a change from old to new, whatever that new is. And it could be something just relatively minor, and the partnership continues on, carries on just as it did before with the change, or it could be something as serious as, death. So, departures, additions, retirement, death, admission, including promotion of a new partner, certainly immediate formation of a new partnership as the business continues, and if a new partner acquires a partnership interest by purchasing from one of the other partners or making a contribution to the partnership. So, there's all different kinds of ways you could have a legal dissolution, but think of it as a change, a change in the old form of the partnership to a change to this new form of partnership. You had partnership AB, it's now partnership ABC. Anything like that. And so we want to look to dissolution when you have a new partner coming in. And so one thing you have to understand when you have a new partner coming in, this can be done several different ways. They can purchase an ownership interest from a current partner, or they could contribute assets directly to the business and take a portion of ownership from the other partners. And the other partners stay on, just have, a different percentage of ownership going forward. And so, just like you saw before, where you have some options on how you account for this situation, the same holds true here. And so, do we look at this as basically the same form of the old partnership, just with minor changes, or should it be viewed as two separate reporting entities? the old partnership and the new. And so let's talk about this. When an individual partner's ownership rights are sold outright to another partner, in other words, you want an existing partner, partner B wants to get out of the partnership, and so they're a 50% owner. They go to C and say, hey, I'll sell you my partnership interest for X amount. C agrees, C buys the partnership interest. What is C getting? Well, understand what B had or has until they sell. B has the right to co-ownership in the business property. Remember that they don't have a right to any particular asset in the partnership. This is the entity approach, that once you contribute assets to the partnership, it becomes titled in the partnership. You no longer have an ownership interest in that particular asset or any other particular asset that has been given to the partnership. You just simply have whatever your percentage ownership is, interest in the partnership. Another right that B has is the right to share in profits and losses as specified in the partnership agreement. And then B has the right to participate in the management of the business. And so when B sells to C, which of those rights can he sell? Well, he can sell the first two, not the latter. Now, understand here that those first two rights can be sold unless the partnership agreement restricts partners' right to sell their interest. And many of these partnership agreements do, because, again, the other partners don't want unwanted partners, even those that they don't give the right to participate in the management of the business. Now, as to that, let's say there is no restriction as to ownership. But basically what happens, I mean, there's several things that can be done if there's a restriction on the sale of a partner's interest. I mean, they can't completely shut out a partner who desires to sell their interest. I mean, usually there's something like a right of first refusal, which means that a partner who desires to sell their interest must come to the other partners or to the partnership, and they have a first right to buy that partner who wants out their shares, or not shares, but interest. And then if they refuse to buy, then that partner who wants out can go sell it to anybody. And of course, there's usually provisions in there. Well, we'll talk about death here on a little bit down the line, so let's just wait for that. And so the right to participate in management, let's say there is no restriction in the partnership agreement. Even if there's no restriction, that third right cannot be transferred without the other partner's approval. Well, why is that? Well, under state law, I mean, this is state law concerning partnerships, the other partners, the partners A and B in my, or A in my example, doesn't want C to come in and start trying to run the business without A's approval. And so this right to approve the management participation of this new partner is pretty important. And so, as far as purchasing a current interest, you can either purchase it from the existing partners, in this case, this is kind of a private transaction. Notice that the cash goes to the partners, not the partnership. So, what does the accountant for the partnership have to do? Simply account for the change in ownership, whatever that may be. Now, there's two methods that are available, as we've seen before, to account for the transfer of ownership. There's the book value approach, and then the goodwill approach. So let's look at those. All right, so we have an example that's also, I believe, in the book. Yep. Scott Thompson and York formed a partnership, and subsequently York decides to leave the partnership. He offers to sell his interest to Morgan, who has no interest yet, obviously. So although York may transfer the right of property ownership as well as a specified share of future profits and losses, the partnership does not automatically admit Morgan. And what they're saying there is he doesn't have an automatic right to participate in the management of the partnership. So he is he would be, if he bought this interest, passive investor basically, unless they agree to let him manage. York legally remains a partner until such time as both Scott and Thompson agree to allow Morgan to participate in the management of the business. And so what they mean for that purpose is, even if he sells his right to co-ownership and share in the profits and losses, he's still considered legally or recognized legally by the other partners as a partnership, unless they agree to allow Morgan to participate in management. He's just not going to receive any of the profits and losses going forward. Morgan would. All right, so for this example, again, it's they don't give you very much information. All right, so for this, York has a $20,000 capital balance. If you look at your book, he has a profit and loss ratio of 30%. Scott has a 50,000 capital balance, 20% profit to loss ratio. Thompson 30% capital balance and a 50% profit and loss ratio. And so again, notice how the capital balances don't line up with profit and loss ratio. Again, these capital balances are just the ins and outs that happen. You know, maybe Thompson took a lot of draws out. That's why his capital balance is so low, even though his profit and loss ratio is so high. You know, if the capital balances match up with profit and loss ratio, it's just by coincidence only. And so you've got capital, the total capital balance here of 100,000. So here it says, instead of York selling his interest to Morgan, what they're doing here is each of these three partners elect to transfer a 20% interest to Morgan for a total payment of $30,000 in a simple capital reclassification. Again, the money is paid directly to the owners. And so he's getting a 20% interest, and after he pays $130,000, what is he going to end up with? And notice here also York stays with the partnership, so he's not cashing out. So this is a totally different example than the one before. So what's happening here? Well, if you look at their entry, what Morgan gets is a 20% share of the total capital. And so they're saying here, well, if he's getting a 20% share and he's paying $30,000, then the implied value of the business must be 30,000 divided into 20%, which happens to be 150,000. So what is 20% of 150,000? 30,000, right? Okay. Another approach, and that's the one they're using here, is just because this is carried out between individual parties and not the partnership itself, the transfer of ownership requires a simple capital reclassification without any accompanying revaluation. And so this would be the bonus method. And so here you're just changing ownership So no revaluation of assets. So what are we doing here? We're taking 20% of Scott's capital. So he had 50. We're now taking away 10 from him. We're taking away 6,000 from Scott. So that's 20% of his 30,000. And then of York's 20,000, we're taking away 20% of that, so 4,000, and turning around and reclassifying that capital to Morgan. Now with the goodwill approach, what you would do here is, again, he's purchasing with 30,000 a 20% interest in the business, which implies that, again, 20%, $30,000, which symbolizes 20% of the interest, means that total capital is 150,000, and so you're going to have, they only have total capital of 100,000 currently valued for this total partnership capital balance, and so they're going to either revalue certain specific accounts or put it all to goodwill or some combination of all that. And then after that, they're going to take this goodwill revaluation, and here they just simply elected to put it all to goodwill, and then they have to allocate that 50,000 to the current partners, Scott, Thompson, and York, based upon their profit and loss ratio. And so 20% goes to Scott, that's 10,000. Thompson gets half, so 25,000, and York 30%, so he gets 15. And then once you've done that, once you've done the revaluation, then now you can acknowledge the entrance of the new partner. And so that's the second entry there. And again, the whole point is that essentially in that second entry, Scott, Thompson, and York have to give up 20% of their new capital balances after the revaluation and transfer that to Morgan. So that's what's going on in that second entry. And really, that second entry, that the $30,000 credit should be to Morgan Capital. It's not enough just to say capital. All right, so Let's look at how it works if the contribution's made directly to the partnership, not the partners. So the new partner can also gain partnership interest by contributing cash to the partnership, not to the partners directly. Remember that the new cash will increase the partnership's net assets. And so again, we use two methods to do that: the bonus and goodwill method. Should start to be a little bit familiar. And so again, we have an outsider. It says, assuming King and Wilson maintain a partnership and presently report capital balances of 80 and 20% or 20,000 respectively, according to the Articles of Partnership, King is entitled to 60% of all profits and losses, with the remaining 40% each year to Wilson. Goldman, the new guy, can enter the partnership for $20,000 cash with the money going into the business. Goldman receives an initial 10% interest in partnership property. So what's going on there? Well, the partnership gets 20,000, right? And then we just have to hash it out accordingly. What essentially is happening, though, is he's getting a 10% interest, and after Goldman gives the $20,000 cash, the total capital in the partnership will be $120,000. So 10% of $120,000 is only $12,000. So I'm not sure why he would do that, give $20,000 to get a $12,000 interest, but so be it. But when you have a situation like that, you're essentially giving a portion, the excess 8, to the other partners. And so that's exactly what's happening here. You debit the cash, you credit Goldman for his $12,000, 10% interest in the $120,000 of capital, total capital, and then you allocate to King and Wilson based upon their profit and loss ratio. So 60% of 80,000 is 4,800, and 40% of 8,000 is 3,200. And using the goodwill approach, you would say, basically you're assuming that if Goldman is paying 20,000 for a 10% interest, then there must be some reason why, and it has to do with unrecognized value in either the assets or something in the partnership. And so that's exactly what's happening in the goodwill method. And so if he's purchasing a 10% interest for $20,000, you take and divide 20,000 into 10%, And what you come up with is an actual value of this partnership of $200,000, right? And so that's actually going to be an increase of $80,000 that has to be implied there to either goodwill or assets or a mix. And so that's what we have here. Here the authors again put it all to goodwill, but it could be to specific accounts as well. The addition of 80,000, and they allocate that 80,000 to King and Wilson, the current partners, based upon their profit and loss ratio, 60-40. And then after that, they simply make an entry recording the receipt of cash by Goldman, and of course record his $20,000 as his capital contribution. So pretty simple. And you notice a pattern, or you should notice a pattern. Now, the authors seem to be highly skeptical of the goodwill method, and mainly because they think it's not based upon valuations. But I would argue if you've got a new partner coming in, I mean, surely they've done their due diligence, and surely, like in this case, Goldman's not going to pay, 10% for $20,000 if the actual value of the 10% interest is $12,000. I mean, it's just not going to happen. So, I don't know. I take issue with the authors on some of this. Now there is, as we saw before, the hybrid method, and just going with the previous example. In this case, what you would do is they kind of changed it up. It says assume that there's a $30,000 value more in the land than what they have on the books. And so the identifiable assets of the partnership are worth $130,000, not $100,000. And then on top of that, Goldman's going to pay $20,000 for a 10% interest. And so what you would do in that case, you would book the land up its value by 30, allocate that revaluation 60-40 to King and Wilson, as they've done here. And then, I mean, still, Goldman's giving $20,000 cash, but he's only getting $15,000 worth of interest. It's the $100,000 initial capital before all this, and then the revaluation of 30 plus his 20 cash. I mean, I don't know. That just doesn't make sense why he would do that. But okay, let's just go with their example. And you know, if he's willing to give $20,000 for 10% interest in capital that's only worth $150,000, meaning he gets a $15,000 interest for $20,000, so be it. In that case, then the remaining $5,000 is split to King and Wilson 60-40. So they're getting to up their capital accounts at his expense. I just don't see that happening in real life. Now you could have a situation that's just totally the other way around, and you know, the new partner you either want to give them a bonus to entice them to come into the business. Let's say the partnership needs new capital and they're trying to convince this party to get into it. So they want to up the ante. You could work this the other way. Now maybe, I guess probably the only reason why in our previous example he might be willing to essentially gift the other two partners $5,000 is because he really wants into the partnership because he sees growth potential. Other than that, I can't think of a reason why that would happen. But anyway, back to this. Here they switch it around to where the bonus or goodwill would go to the new partner, not the existing partners. And again, it might be because the partnership needs new capital. And so here we have Goldman who's going to give $20,000. And after the $20,000, they're going to have a total of $120,000 capital. What they're going to give him is a 20% interest. And so you see here, his capital after this entry is made here on the top is exactly 20% of $120,000 total capital. And so King and Wilson have taken a portion of their capital, $4,000 total, and given it to Goldman to incentivize his wanting to come into the partnership. And so that's the goodwill method. Now, the method down at the bottom, you have to do a little bit of algebra to get to, so I'll let you read that. But anyway, bottom line is they figure out there's $5,000 of goodwill to be given. Sometimes partners want out for whatever reason. They just get tired, they get old. They get pushed out. It's all different kind of reasons for why there might be a withdrawal. In some cases, you might even be able to banish them from the partnership if they're doing bad things. And so here again, back to the partnership agreement. You look to the partnership
agreement to determine how a withdrawing partner is paid out, because that's the operating agreement. So again, we have a couple of methods. Three to be exact. Okay, so using the bonus method, any amount paid in excess of that partner's capital accounts allocated against the remaining partner's capital accounts. Using the goodwill method, the books are first adjusted to fair market value. That should sound familiar. With a proportion of the increase allocated to each partner's account. And then the withdrawing partner is then paid based on the balance in that individual's capital account. I like that approach better, but anyway, this is my opinion. All right, so let's see, in this example, Windsor, you got Duncan, Smith, and Windsor. And so you've got Windsor before the withdrawal, capital balance of $10,000, profit and loss ratio of 20%. Duncan, capital balance of $70,000, profit and loss ratio of 50%. And Smith, $20,000, profit and loss ratio of 30%. So, you know, usually you're going to have to go get some sort of appraisal to do this, to figure out, you know, how much everything's worth. But again, you have to look at whatever the agreement says. I mean, they may actually have a figure agreed upon. So it's just kind of whatever they agree upon. All right, so in this example, they have an agreement to appraise the property, and after this appraisal, the fair value is estimated of the property of $180,000, which is $80,000 in excess of book value. And so land held in the partnership is currently worth $50,000 more than its original cost, and the other $30,000 is goodwill. And so what is Windsor going to get? Well, he's going to get his original $10,000, plus he's going to get 20% of the revaluation, the $80,000 excess. So 20% of $80,000 is $16,000. So he's getting $10,000 plus $16,000, which is $26,000. And so under the bonus method, what you're doing here is you're going to remove Windsor's capital account, of course. He's withdrawing $10,000, but he's getting $26,000 of cash. And so the other $16,000 gets allocated to Duncan and Smith. And so, and it's done in proportion to their profit and loss ratios. And so for Duncan, he's getting 5/8 of the 16,000 allocated to him, because his profit and loss ratio is 50%, and Smith's is 30%, so that's a total of 8, right? 80. So anyway, 5/8 and 3/8 is what you got there. Now, using the goodwill method, what you would do is revalue the land and book your goodwill for the 80,000. You would update each partner's capital account, increasing them by their profit and loss ratio. At this point, after this entry, Windsor's capital account now consists of his original 10,000 plus this 16,000, or 26,000. And so after that, what do? Well, you remove Windsor's capital account of 26,000 and you credit cash. So that's pretty easy, right? And for the hybrid method, you wouldn't book the goodwill. You would simply increase the value in your land, and then you would allocate that increase according to the profit and loss ratio to each current partner. So 50, 30, 20 of 50,000. And then you're going to turn right around and you're going to pay the $26,000 cash. At this point, well, before this entry, Windsor's capital account consists of his original 10 before this first entry, plus the 10 due to the revaluation of the land. So now 20. So you're removing Windsor's 20,000 total capital balance. And again, since he's paid 26,000, you have to allocate the 6 between the two remaining partners on a 5/8, 3/8 basis. So anyway, that's kind of how that works.